Imagine oil gets expensive, fast, not because the world is booming and demand is roaring back, but because physical supply just can't get where it needs to go. Now stretch that disruption across months, not days. And suddenly the story stops being higher prices, it becomes something more serious, not enough supply of the materials that keeps factories running, crops fertilized, and economies moving. Today, the Strait of Hormuz blockade is already in its third month, and the global economy may be entering a two-stage shock: inflation first, then growth. Welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. As we entered a third month into the blockade of the Strait of Hormuz, the implication is increasingly important. The world, especially Asia, could be operating with an effective supply gap of around 14 million barrels per day, and that's not just crude oil, but also natural gas and a wide range of petrochemicals and derivatives, inputs that feed into fertilizers and countless industrial processes. In April, the pace of oil inventory drawdown was roughly 7.1 million barrels per day. And if that continues, we move from prices are rising to a more disruptive reality: inventory drain. Essential inputs get scarce and production slows down. Now, everyone hopes the blockade is removed in the coming weeks, but with negotiations between Washington and Tehran at a stalemate, the key message is we should be hoping for the best, but at the same time, don't get too complacent. So what can we learn from history? Let's start with an analogy. A thunderstorm can be life-saving after months of drought or catastrophic after weeks of heavy rain. Same storm, different backdrop. Oil price surge works in the same way. Since 2000, many of the big oil price increases were tied to demand recovery. Think the rebound after the global financial crisis or the recovery after the COVID shock. Prices typically rose from depressed levels, and the macro message is often growth is coming back. There were also supply disruptions, but often small enough that other producers could offset them. Even the Russia-Ukraine war, which meaningfully disrupted energy flows, had important differences. Russia accounted for roughly 10% of global oil and 17% of global natural gas supply. Europe felt most of the pain, but because the disruption was heavily shaped by sanctions rather than the total physical blockade, the global supply chain shock was less abrupt. Plus, that period overlapped with a strong post-pandemic rebound, growth momentum was firmer, and central banks were tightening from ultra-loose setting towards something closer to neutral. This time, the setup looks different. So if the disruption in oil supplies extended, we could see a two-stage process starting with an inflation shock. So first, energy prices rise rapidly. 2 months into the conflict, Brent crude once hit $118 per barrel back in March, a gain of about 63%, and now settle at around $110. If oil reaches $150 per barrel in coming weeks, that would mean prices would have more than doubled since the conflict began. Historically, moves like that, if driven by demand, tend to unfold over quarters or years. Here, the speed is the tell. This is a supply disruption pushing prices up. As a result, someone has to pay that cost. Either businesses absorb it via lower margins, or consumers pay it through higher prices. In practice, oil prices and the US retail gasoline prices tends to move together, so a meaningful portion often get passed through to consumers. That feeds inflation and raises the risk of central banks responding, especially if they fear second-round effects. So policy response can diverge. Some central banks, such as the Federal Reserve, may adopt the wait-and-see approach. Others, such as the European Central Bank and the Bank of England, may tighten preemptively to contain inflation expectations. And meanwhile, governments may step in with buffers such as fuel subsidies or price caps to limit the shock to the households and businesses. Then we get to the second stage, the growth shock. It's about fiscal constraints. When disruption persists, it restricts not just crude supply, but also the petrochemical chain that underpins industrial production. And energy markets are slow to adjust. Drilling, refining, and investment in infrastructure takes time. So instead of supply rising quickly, the adjustment can come through demand destruction. Economic activity slows because inputs are unavailable or too expensive. Some products, such as sulfur, are byproducts of refining and processing, but are also raw materials for broader industrial use. If inventories decline far enough, shortages can ripple into energy generation and manufacturing, forcing cutbacks in production. And the hardest part, the turning point is difficult to pinpoint. Inventory levels and drawdown rates vary by market, and starting inventory levels can be opaque. Layer on top of that, higher cost of living and doing business can undermine consumer and corporate confidence. The sentiment impact may lag, but it compounds to the downside risk. This brings us to a very difficult macro scenario to set up portfolios for: stagflation. Inflation pressure plus weakening growth, it puts central banks in a dilemma: hike to fight inflation or to cut rates to protect growth. So let's come to the bottom line. How have assets behaved during oil price surge? A key takeaway is that when oil prices rise due to demand recovery, risk assets often do fine. Equities tend to rebound with growth. But this episode is different because it's tied to an abrupt supply shock. So historical comparisons tend to focus more on episodes like the onset of the Russia-Ukraine war. A few consistent observations emerge. First, energy and utilities within the S&P 500 tend to hold up better, and also across episodes. They often posted positive returns. Number two, during the Russia-Ukraine episode, many cyclical sectors struggled, particularly where higher rates and tighter policy expectations were headwinds. That included areas such as financials, technology, consumer discretionaries, and communication services. Number three, in fixed income, inflation-linked bonds tends to outperform developed markets government bonds across episodes and were among the few areas generating positive returns during the Russia-Ukraine shock. Along the yield curve, when growth comes under pressure, the long end can outperform the short end, even if inflation risk is still present. However, in the near term, because growth momentum is still looking relatively solid, long-duration fixed income could still suffer. And finally, gold sometimes helps to offset equity drawdowns, although the magnitude has not been consistent. The bottom line is, with no clear path yet to reopening the Strait of Hormuz, investors may want to hope for the best, but prepare for volatility if growth becomes threatened by prolonged disruptions. And importantly, history suggests that prepare does not automatically mean rushing into cash. It can mean positioning more deliberately for inflation risk, growth risk, and also sector dispersion. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing if you've not already done so. If you have any questions, feel free to reach out to your JP Morgan Asset Management client advisors, and they'll reach out to us. My name is Tai Hui. I'll see you in the next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.